On a Monday morning in September 2008, one of the oldest banks in America died. It was 158 years old. It survived 2 world wars and the Great Depression. It did not survive that weekend. Within weeks, the entire world's money system nearly stopped. Trillions of dollars vanished. Millions of people lost their homes, then their jobs, then their savings. And the craziest part? It all started with something completely boring. Regular people buying regular houses. Here's the whole story, piece by piece, so simple a 6-year-old could follow it. Let's start with how buying a house is supposed to work. You want a house. You don't have $200,000. So a bank lends it to you, and you pay it back over 30 years, plus a little extra. That extra is the bank's profit. This is called a mortgage, and it's one of the most boring inventions in human history. And boring was good. Because the bank was lending its own money, it was extremely careful. Do you have a job? A salary? Savings? Will you actually pay this back for 30 years? The bank checked everything, because if you stopped paying, the bank lost. Banker lends carefully. Family pays slowly. Everyone's fine. A boring machine that worked for decades. And then, some very clever people on Wall Street looked at this boring machine and asked a question that would eventually break the world. What if we could sell the boring? Here's the clever idea. A mortgage is basically a promise. This family will send money every month for 30 years. And a promise of future money is worth money now. So the banks started doing something new. They'd take your mortgage and your neighbors and thousands of others and stuff them all together into one big box. Then they'd slice the box into pieces and sell the pieces to investors around the world. Pension funds in Germany, insurance companies in Japan. Whoever bought a piece would receive a slice of all those monthly payments. The banks loved this. They got their money back instantly instead of waiting 30 years, and they charged fees for making the boxes. The investors loved it too. Steady, safe income from thousands of families. What could be safer than people paying for their own homes? To make everyone comfortable, special companies called rating agencies inspected the boxes and gave them grades, and they kept stamping the best grade on them, AAA, the golden star. As safe as it gets, they said. Safe as government bonds. So money from the entire planet poured into American mortgage boxes. Everyone wanted more boxes. And that right there is the moment the machine broke. Not with a bang. With a quiet little question asked in every bank in America. If we just sell the mortgages anyway, why are we being so careful about who we lend to? Think about what changed. Before, the bank kept your mortgage, so the bank cared deeply whether you could pay. Now the bank sold your mortgage within weeks. If you stopped paying 3 years later, that was some German pension fund's problem. The bank had its money and its fees. So the checking stopped. First, they lent to people with shaky jobs. Then to people with bad credit history. Then came loans with no proof of income at all. There was even a nickname for the worst ones, ninja loans. No income, no job, no assets. Didn't matter. Stamp it, box it, sell it, next. These risky mortgages had a polite name, subprime. Think of them as rotten strawberries. And here's the trick that made it all possible. If you blend a few rotten strawberries into a giant smoothie with thousands of good ones, the smoothie still looks pink and delicious. The rating agencies kept tasting the smoothies and stamping AAA on them, partly because the math said risk was spread out, and partly because the banks making the boxes were the ones paying the rating agencies. Grade our smoothie too harshly and we'll take our business to your competitor. More rot went into the boxes every year. The stamps stayed golden. And why did anyone take these crazy loans in the first place? Because everyone, from the banker to the buyer, believed the same magic sentence. House prices only go up. If you couldn't pay, no problem. Just sell the house for more than you owed. Under that one belief, no loan looked risky. Sound familiar? It's the exact same sentence that built 90 million empty apartments in China. Wall Street wasn't done though. They built boxes made of pieces of other boxes. Then they invented ways to bet on the boxes, like sports betting, but on whether strangers would pay their mortgages. Some smart people quietly started betting the whole thing would collapse. The pile of bets grew many times bigger than the actual houses underneath. One belief was holding all of it up. One sentence. And in 2006, the sentence stopped being true. Many of these risky loans came with a trap built in. Tiny payments for the first 2 years, and then the real payment kicked in, sometimes double. The plan was always to sell or refinance before the trap sprang. That plan needed prices to keep rising. They didn't. America had built too many houses, sold to too many people who could never afford them. Supply everywhere, real buyers running out. Prices flattened. Then, for the first time across the whole country since the Great Depression, they fell. Now the trap sprang on millions of families at once. Payments doubled. Selling was impossible because the house was suddenly worth less than the loan. So people did the only thing left. They mailed the keys to the bank and walked away. Every abandoned house went up for sale, pushing prices lower, springing more traps in more neighborhoods. A doom loop, the same monster we've seen before, just wearing an American flag. And now, follow the money backwards. Those monthly payments were the juice flowing into the magic boxes. Payments stop, boxes stop paying. Suddenly, everyone holding a AAA Golden Star box looked inside and asked a horrifying question. Wait, how much rot is in mine? Here's the thing about the smoothies. Nobody could tell anymore. The good and the rotten had been blended so many times that not even the banks knew what they were holding. So the price of every box, good or bad, collapsed together. Trillions of dollars of totally safe investments suddenly worth nobody knew, and nobody knows is the most dangerous price in the world. Banks lend each other enormous amounts of money every single day. It's the plumbing of the world economy, and it runs entirely on trust. In 2008, trust died. Every bank knew its own vaults were stuffed with rotting boxes, which meant every bank assumed everyone else's were too. So they stopped lending to each other. Completely. The plumbing froze. In March, a giant investment bank called Bear Stearns collapsed and was sold off in a weekend fire sale. The system shook, but held. Then came September, and a bigger domino, Lehman Brothers. 158 years old, stuffed with mortgage boxes, out of cash, out of friends. Everyone assumed the government would save it. The government let it fall. The biggest bankruptcy in American history, over $600 billion. And that was the moment the panic went global. Because if Lehman could die, anyone could die. Markets crashed around the world. The giant insurance company AIG, which had insured mountains of these boxes, collapsed within days and had to be rescued with taxpayer money. And here's where it stopped being a Wall Street story. When banks freeze, they stop lending to everyone. Businesses that borrow routinely to pay salaries suddenly couldn't. Factories closed, millions lost jobs, in countries that had nothing to do with American mortgages. A farmer in Brazil, a factory worker in Slovenia, a shop owner in Japan, all hit by boxes they'd never heard of. The world economy was having a heart attack. And there was exactly one player left rich enough to restart the heart. Governments. In October, the American government approved $700 billion to rescue the banks. Central banks slashed interest rates to zero and created trillions of fresh dollars to pump into the system. The phrase everyone learned that year, too big to fail. Meaning, these banks are so huge that letting them die would take everyone down with them, so we have to save them. And it worked. The heart restarted. The total freeze of the world economy was avoided. But now look at it from a regular family's kitchen table. The banks that caused this got hundreds of billions. Some bankers collected bonuses the very next year. Meanwhile, roughly 10 million American families lost their homes. Unemployment hit 10%. Ordinary people paid for a party they were never invited to. Almost nobody responsible went to jail. In the entire crisis, one single Wall Street banker was imprisoned. One. That rage never really went away. It shaped politics for the next decade, everywhere. And in 2009, in the middle of the wreckage, an anonymous person calling themselves Satoshi Nakamoto launched a strange little project. Money with no banks in it at all. They called it Bitcoin. But that's a story for another episode. So what actually caused 2008? Not one villain. A chain. Banks stopped checking because they didn't keep the risk. Rating agencies stamped gold stars on rot because the rot paid their bills. Investors didn't look inside the boxes because the stamps looked official. And everyone, everywhere, believed the magic sentence. Prices only go up. Here's the lesson, and it fits in one line. When nobody holds the risk, nobody checks the risk. The moment people can pass a problem along and keep the fees, the problem grows in the dark until it's big enough to eat everyone. Could it happen again? The rules got stricter. Banks hold more emergency cash now. But the magic sentence? People are whispering it right now, somewhere, about something. They always are. So here's the question. What do people around you believe can only go up? Drop it in the comments and subscribe. One money disaster every week explained like you're 6. Monster out.